Hey, future millionaires, welcome back to Trade and Voyage with MK. This is MK, and today we are diving into moving averages, simple moving average, and exponential moving average. One of the most powerful trading tools for trend identification and trade confirmation. If you have ever wondered how to follow trends, where to enter trades, or how to avoid bad signals, this lesson is for you. Moving average helps traders smooth out price action, filter noise, and identify trend direction with accuracy. By the end of this lesson, you will know how to use simple moving average and exponential moving average for trend trading, how to combine them for better accuracy, and how to apply them to your gold trades. Let us dive in after the intro and disclaimer. Mastering moving averages, SMA and EMA for gold trading. What is today's agenda? Understanding moving averages, how moving average helps in trading, SMA vs EMA key differences, best moving averages for gold trading, moving average crossover strategy, using moving averages as dynamic support and resistance, combining moving averages with other indicators, summary and key takeaways. What are moving averages? Moving averages are indicators that help traders analyze price trends over a specific period. There are two types of moving averages. Simple moving average, which calculates the average closing price over a set of period. Another one is EMA, exponential moving average, gives more weight to recent price for a faster response. Other than this, many of other moving averages there. We are today only discussing about simple moving average one and exponential moving average. We will go to trading view chart and will add moving averages and how to work it. We will show. This is 50 minutes chart of gold. So we will know how to add the moving average indicators. Go to the indicator section here, top of the our trading view chart. In search here for the symbol moving averages, we will search symbol. So will come this moving average symbol. This is one of the indicators someone customized. We have to take this one, moving average symbol. Okay. Once you plotted this one, moving average symbol, one blue line plotted our chart. What is this? This is a symbol moving average. The general setting, default setting, it will be SMA 9 close, means it is a 9 period moving average. Go to here settings. Then here we can change our length. If you want 5 minutes, then put the 5 minutes. Then it will be 5 minutes moving average. Then I will plot the another one for the exponential moving average. For exponential moving average, we have to type. This also default what will come. It is a 9 moving average, 9 period moving average. So we can set it as a 5 or whatever you want. You can put 50, 100, whatever the value you put in, it will come here and you can see the differences. Okay. We will explain later all the things how to use this indicator. Now just how to plot the indicator. Okay. For here you can see this go to the style, you can change the color. Now for exponential I will put the red. Okay. And this is the exponential moving average and this is the EM. So we will do the same scenario. It will be same. We will put 5. That is the blue one is symbol moving average and red one is exponential moving. There is a slight difference. We will explain later what is that differences. And I will explain to you how to this calculation happening. Okay. Moving average. 5 moving average means 1, 2, 3, 4, 5. Last 5 candles close will take the average. Then it will plot the line here. So we can example here. What is the price here close? 2489.94. Okay. So we will put here 29. What was that? 29284994 plus next candle close. It was 2854.65. 2854.65 plus what is next candle close? It was 28 54.58, 2854.58, 2854.58. Next candle close is 2856.76, 2856.76 plus, what is next candle close? It was 2857.44. We'll add this all, then we'll adding this one, we'll see how is the amount coming here. What are our values here? We will put 2849.94 plus 2854.65 plus 2854.58 plus 2856.76 plus 2857.44 equal to this one divided by, what is our moving average? Now we used 5. It will be divided by 5. Then you can see the average 2854.674. I will write that one average here. Average was 2854.67. Okay, 2854.767. What we did, we added all this and divided by 5. Why it is divided by 5? Because we are taking the moving average, 5 period moving average. You can see here the blue is our symbol moving average, 2854.567. You can see this one here value 2854.67. What we got the value also? Yeah, this is same value we are getting. So if you are changing if moving average for 9, then what will you have to last 9 candle close, add plus divided by 9. So making it easier, this will be plotting our chart. So exponential also same, like how many moving average we closing, that last price action will be taking on that one. Okay. So if whether we change this SMA to 10, what will happen? The 10 value will be changed. Then if you are taking that 10 last close of candles divided by 10. See, the value already changed. Now what is the value? 2851.98. I'm not going to calculate all. It will be lengthier video. So this is a simple method to how to identify the moving average. But you don't want to study about the calculation. I am just teaching you to understand what is the scenario behind this moving average and what is the calculation behind the moving average. It is simple. Just the last how many period you are using, that kind of period, 1 2 3 4 5. If you are using 5, then this 5 candles close will be added and divided by 5. If you are using SMA 10, then it will be 10. You can see here input, you can see here smoothing and calculation, any time frame. So is always we are using close. If it is open, then what they will use, all 5 candles open price will take, but usually this is used for close. You can change the color of your EMA, SMA, anything. You can change the color. You can see when you are changing color, it is changing, and you can change the thickness here, opacity, how the visibility, all you can change here. This is only the simple moving average, and this is exponential moving average. It is nothing. There will be some lanes plotted in your chart. It will act as support and resistance, all we will study later. Just now I introduce how the psychology behind the moving average. Have you used moving average before? Drop a comment below. How moving averages help in trading? Moving averages are used for trend identification, support and resistance, and trade confirmation. Why use moving averages? Identified trend direction. Rising moving average, uptrend. Falling moving average, downtrend. And find dynamic support and resistance. Price reacts around moving averages. Generate trade signal. Crossover indicate entry and exit points. Check your charts. Does price respect moving average? Comment yes or no. We will move to trading view chart and how the reacting for the moving averages. Uptrend, downtrend, falling moving average. This is the 50 minutes chart of gold. Okay, so we will use EMA to show you here. What is EMA 5 means? It is the last 5-minute candle average. Okay, if you are changing to normal, what will be coming? Default is coming 9, and for the intraday 50 means what we normally using 21 EMA. Okay, see, if you are using 21 EMA, how it is reacting to the price, we will see. But we say that if it is falling EMA, you can see it is a falling EMA, it is a downtrend. You can see falling EMA coming and coming here, it's taking resistance to EMA and coming once break, again it is breaking, it is taking as a resistance. Okay, break and taking as a resistance. It's all falling moving average here. If it is falling means it is like it's a market is in a downtrend. Okay, where we can see the up movement, you can see this was an up area, up movement of the moving average. You can see here, from here what happened, EMA started to rising. That means the price also rising, there is a chance for the uptrend. You can see it's a rising moving average. You can see here somewhere what is here, this is like a sideways movement. The price is touching moving average here and there, that area, to avoid the trade. You can see here, once it's broke this one and like it was clearly respecting, here you can see it was taking, it was breaking and coming to take the resistance to the moving average. Once again coming back to the moving average, what is doing, again taking the support, coming here and taking the support, and once it's failed, what is happening, it came to falling average. Once happened, then it is taking as a resistance here. This is the example of the simping moving average, or no, exponential moving average of 21. So if I will take the 50, that means last 50 candles. Okay, this will be average for the last 50 candles. You can see it also, it was in a falling, clearly coming here, respecting here, it that's known as a dynamic resistance. This is why earlier tell it will act as a dynamic, it will act as a dynamic support and resistance. You can see here this was in falling, then we can see how this is the 50 moving average, exponential moving average. It was rising, once again coming back to the price to the moving average. What is actually happening is taking as a support. See, everywhere it will be like that. So if you are taking EMA 50, 100, each moment you can see all this scenario in your chart. So check your chart plotting the moving averages, then see how price reacting to the particular level. And there is a, for scalpers and intraday traders using small moving averages, and for the swing traders and like long-term investor, they will use for the simping moving average above 200. It's a long-term trend. We'll study it later. Okay, now hope you understand how to the plot the moving average and how it is reacting the price level. This is now I am only putting only one exponential moving average. There is a multiple moving average will be can use, and there will be many strategies across that one, that we will study later. Okay, SMA and EMA are used differently depending on your trading style. SMA, simple moving average, better for long-term trend analysis, smooths out price fluctuations, good for swing trading and higher time frames. Exponential moving average, more responsive to recent price action, ideal for short-term trading and quick entries, commonly used by day traders and scalpers. We'll move to the trading view chart and overlay the SMA and EMA on the same chart to compare their responsiveness. This is the 50 minutes gold chart. Now what we plotted here, EMA we can put 21 EMA. In simple moving average also we can put 21. So both are same candle moving averages, but you can see the differences here, right? Slight differences are there. Sometimes you can see here, example last area, this is the red is the exponential. It was price rejecting from exponential moving average but didn't touch the simple moving average. We said that day traders and scalpers will use simple moving exponential moving average because it will be more accurate and like fast movement. You can see compared to simple moving average, exponential is fast reacting and price also reacting. But if you are taking higher time frame, and for that one they will use for the simple moving average. Many times you can see here, but it's price reacted from the simple moving. From the exponential, it was not reacted. It was reacted from the simple moving average. It is nothing. Just you can see there is a slight variation only will be happening there for the simple moving average and exponential moving average. That is the difference you can see. It is in 21 moving average is different. So we will change it is to 50. Both we will change to 50 moving average. Then we will see the difference. SMA we already changed to 50. Then we will change this one also 50. So I will change the style also. We can increase the thickness so we will understand easily. For this one also we can increase the thickness. See what is the difference? Small difference always. Same coming. Slight difference also coming. So there is not that much difference actually exponential simple moving average. You can consider only one. If you are a day trader, scalper trader, you can use exponential moving average. If you are a swing trader or long term trader, you can use a simple moving average. But don't use both, then it will make you confused. Okay. Now this is the exponential moving average of 50 and simple moving average also for the 50. Then if you how to change from here, if you go here indicator here, then plus settings, input, I will change to 200. It is the long-term trend identification moving average. You can see change. I am changing this one to 200. Then what is happening? This both are now 200 moving average. Okay. You can see while what is happening for 200 moving, now it is both are falling. And you can see here it was reacted to the exponential moving average. It didn't reach to the simple moving average. That's why always telling that it is a fast reacting moving average. Simple moving average will be little slow than compared to the exponential moving average. It is all now it is falling moving average. We can say that is a long-term trend is in the 50 minutes, it's in the downtrend. Then once it is cross over that, it will be uptrend. You can see moving averages floating like this. It is a sideways movement. Once you see this kind of moving in, whether it is not rising or falling, avoid the trend. This area we can say that it's a like sideways movement. Once it is started falling, you can see then it is in a trend. Once falling happen, you can keep this as a resistance area. Once it's coming near to the exponential area, you can plan for the short trade, means sell trade. The best moving average for gold trading. Choosing the right moving average period is a key. Commonly used moving averages are short-term traders 9 EMA, 21 EMA and 50 SMA. For swing traders, what they are using 50 simple moving average and 100 SMA. Long-term traders, they will use 200 SMA for major trend direction. What moving average do you use? Let me know in the comments. We will move to the trading view chart and we'll see how this behave on gold charts. This is a 50 minutes chart of gold. We can see what we say that one accordingly we can use for the 50 minutes. For we will see the intraday traders. Okay, they will use commonly using that 9 EMA or 21 EMA. We'll go to that 21 and 91 EMA. This is a 9 EMA. SMA will close this and hide this one. Okay, so it is the 9 EMA for the scalpers. They will use for the scalpers. Once they break, they will retest, they will take trade like you see here. Once it's break, they will take the trade here to break an area, then they will continue until here when they will close their trade after one candle closure. Other EMA they are using is 21. 9 EMA is using only for the scalpers. It's very fast movement because you know that one. It will be last 9 minutes kind means five. If it is 5 minute candle means last 5 minutes candle. 1, 2, 3, 4, 5, 6, 7, 8, 9. So its average it is taking. So we will change to 21. It is the 21 last 21 candle of 5 minutes chart. Okay, what they will use also same, it is using for their trade entry and exit. You can see once it is break this area, once they see that is a falling, then breaks one area, then what they will do, they will plan trade for that breaking candle or once again coming to the moving average. And if see any price action, now you can see they see the engulfing candle and closing below this one, so they will plan trade. They will run their trade until here. Once back any candle close above this one, then they will close. Someone will fix their will fix target. They can take 1:2 or 1:3, or someone will be trailing their profit until they see one any of the candle close above this moving average. This is their usually using 9 and 21 EMA. If they are using SMA in this period, what they will use 50 SMA they will use for the day trading. We can change it to as a 50. We will see how it is reacting. 50, then want to show this one we will use. You can see 50 SMA how beautifully reacting. Once it is falling, okay, then it's break the moving average, and once come back, it was beautifully reacted for this one. Then coming back again to the symbol moving average, it went back to fall. Okay, once it is break here, but we couldn't see this is a rising. Okay, so we will not plan any uptrend trend, means buy trade we will not plan because we didn't see it is rising. It is flat. Actually, we can say it is a flat one. We say that if it is flat, we will not plan any trade. Again, we can see it is started falling and it is break the moving average. Then once it's coming back, you can see how reacting the price about the moving average, beautifully reacted and falling down, down, down. Okay. Again, it is broke, but you can see it is falling, so we will not plan any buy trade. Once it is started rising, you can see from here it started rising, and one coming back, yeah, it is working also. Same like this, you can use this moving average to identify trends. Okay, if it is flat, no need to take any trade. If it is falling, you can plan for sell. If it is rising, you can plan for buy sell. It is all for to understanding, and without indicator you can trade. But this one, why I'm teaching all this one for the beginner trade, because price action will not understand easily from the beginning. So using this kind of indicator, which is trusted indicators, they can plan their trade accordingly. It will be a mechanical way, because once it is they see this one is plotting as a rising, then they will plan buy trade like that. For the sync traders, what they are using, they are also same using 50 SMA they will use, and 100 SMA also using. 100 SMA if you go for the sync traders are using 4 hour or 1 hour. If you are using 1 hour, and you can see 100 SMA, we can change it to 100, how it is reacting. For that one, they will enter and it will take time to exit the trade. From here, you can see rising, it reacted. Once they close here, it started the falling. You see, it is good reaction, right? It was a falling, a rising. Once price is broken and come back to here, then it went. Once you see any candle closure here below, then but we will not plan for the sell. Why? It is was a falling and not rising. Once candle close and started to falling. See from here, this swing trader, they will hold until you can see again it will come back to here. There is a chance to come back from here, unless they will close the trade. Any of candle closing here above here, then it started to rising, they will close their trade. So everywhere you can see how, see, once it was rising, price coming back to here. Always you can see it's a rubber band effect. One price move away from the moving average, of course it will come back to this one. It's a pullback. We are saying it's a pullback. You can see always it's coming back to near to the SMA. You can see if it is exponential moving up, maybe it will come to here. We can see 100 exponential moving average. Sometimes it's already, it is a fast, right? So it is, you can see from here it's, yeah, touch here, here touch. So any of the moving average you can use, or you can use both, then you can get accurate entry. Okay, so once it is close here, no will not take for sell, both to close. Like that, you can take this as a for accurate entry. You can use both. It's simple. Okay, add the moving average, wait for to the rise or fall, then plan accordingly. So it will be removing the noises also, like sideways trend you can avoid this time. You can see here how this was a trend rise, because you can see this was not a falling or rising, it's like showing flat. Once it was a falling, it keep going, price going to keep falling. Moving average crossover strategy. One of the simplest yet most powerful trading strategies is the moving crossover. How it works? When a short-term moving average crosses above a long-term moving average, it's a buy signal. It's known as a golden cross. When a short-term moving average crosses below a long-term moving average, it's a sell signal. It is known as a death cross. We will be seeing it moving up. We can go to the trading view channel. We will check how it works in a trading view chart. It is 50 minutes gold chart. We will see what we see that there will be long-term and short-term moving average. You can see here exponential moving average, we will take it is a 50, and we will add one more exponential moving average. We can put it as a 20. What is the strategy? Saying that if long term, this is a long term red color, that is the 50 moving average, okay, and small one is the blue, and it is like 21 moving average. So for the sell signal, what we have to get this short term here. What is our short term? It's a 20 moving average has to cross the long term. Here long term our is the 50, the red one, okay. Once it is crossed from up to down, then it is a here it is a sell signal, okay. What we have to do, this is our sell signal area. Once we get this cross, then after any of the candle closure, we can take the trade for the sell. So what is the buy condition? Same. From here long term was in the down term, this short term moving average in the down, and once it is coming here, you see when it came, yeah, we got the one cross. Once price coming back to here, you can plan for the trade here. Once coming back to moving average and it is a low, you can put it as a low here. You will get 1:2. Easily 1:2 you will get. See, this is a simple strategy for the beginners also. What is our strategy? You can see once price cross here, this area, this our moving average 20 cross the moving average 50. After that, what we have to do? We have to price come back here. Better to, once here, then price to mark this candle before that crossover and second candle. This is the area here. We can mark here. Sometimes, yeah, it came here. Better what we will do here, from here, if it cross here and the candle before that closure, which cross both the candle, we will mark, okay. Once it is coming back to here, we can plan the trade here. You can put the high of that candle and 1:2, or here what we get, if you trailing, you will until here you will get this one to the 5, 1:5. You can check another area. Once it is crossing, then you can plan the trade. What we say, when it is cross, we will mark the this candle which one is cross, then we plan 1:2. See, it's getting 1:2, 1:2 or 1:3, easily getting 1:3. Yeah, after 1:2 you can like it make it a break even, then trial up to 1:3. Here you can see this is flat. We will not take the trade here. Once if you want to take, okay, what is the candle here? This is our candle. It will be stop loss. Here also you can see the candle close here. Then once coming back, it is going up. Here also flat. Will not take. It was cross here. Here cross happened. You can see once it's cross happened, then we will mark this candle You can mark this candle. You can take the trade accordingly here from here. And 1 is to 2 or 3. You can see 1 is to 1 is to 2 is getting. From 1 is to 2 it is going back. Now we can check with this one. Now we use 50 and 20. But actually now we can use the 200. That is the popular one. 200 with 20. Moving average 200 is our long-term trend moving average and short-term is 20. You can see this crossover happened. We will see the one crossover happen and we will mark the candle that crossover which candle crossed the moving average. So we can plan long term because even it is coming close here down, no problem because our long term is still in the buy position. Okay, just put the stop loss here. We can 1 is to 2 or 1 is to 3 mark. You can see if you are putting this low or high, you can get it 1 is to 5, but I will not suggest for 1 is to 5. We will 1 is to 2 first. Take 1 is to 2 first, then after that trial your stop loss until 1 is to 3. Once you reach 1 is to 2, close your partial and trial the balance, putting your stop loss on break even and continue. Or what you can do after taking the trade here, you can close the trade once any candle closure above this short term period. You can see here. This is a trailing method. Okay. You can see this candle closed below the your short term period. So what is your it will be trade will close from here once this one happen. Okay, what is your risk reward ratio? 3.86 you got. So this say we don't have any trade opportunity here. Here you can see once it came back to here but crossover didn't happen. Once coming back to here, here there is no crossover, but you can see this is already rising and this is also up area. So once you get this candle closure above here, you can plan the trade here. Then yeah, you get entry after this one. The same what we'll plan when it is closing the below of 9 shorting period. Here no didn't close. This is the candle close. Okay, after this candle immediately we will close the trade. How much you are getting, we'll see. That also getting 1 is to 4. It's a simple strategy, right? But the risk reward ratio also good. Next we will check another trade. It was here. You can see here we will not buy anything. Here crossover happened here. After crossover, what is our scenario? We will which one is the our candle to buy and mark? This is the candle. Okay, which one? This is the one broke the our long-term 200 moving period. So we will mark it as a box. Just take the trade from here, and once we get entry, what we have to wait? Okay, here we got one candle closure. We will close the trade first here. It's 151.57. Then again what we will do, once candle closure above here, we will take another trade. Take another, because why it is closed? We are taking not fixed 1 is to 2. Any candle closure below our short term, we will closing. So as per our rule, we have to close here. Then again, if any candle is closing above the short term, we will take the trade. Same, we will take here, and our stop loss will be here. Where is our closure? Yeah, it's coming here to closure. If you are not trailing, you can fix. You see, it went until to 1 is to 5. But if you are trailing, once candle closure here, what is the price you are getting? So 2 is to 87. But sometimes it will get high, or you can put fixed 1 is to 3. You will get 1 is to 3 easily here. That is up to you how you are risking your trade. And always, as I say, risk management is important and be careful on that one. You can see it is so simple and most powerful strategy, crossover strategy. It's known as a golden cross because crossing from below to longer trend from, if it's coming from here, it's known as a golden trade, golden crossover. can see here what is happening. Called crossover didn't happen because it's come to here. Then after that, you got this trade here. It will go up. You can close the trade until here. And you can see the price when away from the moving average, it will comes to here. You can see it was away from here, coming back to moving average. Wherever the price going, it will come to moving average. That is a rubber band effect. You can see any time coming back to the moving averages. It will come back to your moving averages. So accordingly, you can use any of crossover strategy. This is 220. Same like you can make anything to 120. Which one is best working for you? You can use it. Okay, but this is all common. 220 is the common one, and it is most powerful. So whenever coming, this is the long term. So this is long term means falling means we have to look for only the sell trade. Once this coming to near to this area, price coming to this 200 area, and once price came there and crossing below the short term moving average, you can plan the trade. Once you get this one, after this closure, you can plan your trade here. Then target is like you can trial the target or can put here stop loss or here. Both this one is the safest stop loss, but you can only put here also. Then what you have to do, wait for any candle closure be above this one, 920 moving. Once you are getting here, you can exit the trade. It is getting 1:4. You can see 1:4.6. If you are risking $100 here, you are getting $461. You are risking $1,000, then you are getting $4,610 profit here. Using moving averages as dynamic support and resistance. Moving averages act as flexible support and resistance levels. That is known as a dynamic because it will vary, not as a fixed support and resistance. The price range will be vary according to moving average. How to use moving average for support and resistance? In an uptrend, price bounces off the moving average. It will be a strong support. In a downtrend, price rejects the moving average and it acts as a strong resistance. Break and retest of moving average confirms trend continuation or reversal. Check your charts. Do you see price reacting to your moving averages? Comment below. Yes, if you do. We can see a chart of gold bouncing from a moving average. We can use here 20. Okay. We can see how price reacting from the particular moving average area. But see in the uptrend, what is this? Rising. Okay. Once coming back to here, it start bouncing from here, reacting from the here. Once coming back to here, it is bouncing again. It was falling, sorry, rising, then it come back here, it's uptrend moving. Now it started to falling. Once price coming back to here, it's reacting. If it is rejecting means it's a resistance. See here, once coming, this was a falling moving average. Once coming to this price to this area, it's rejecting. It's a fake breakout because it didn't close this one. Price again coming here. You can see here, price coming cross here, coming back to moving average. From here, when touch moving average, is rejecting. Near to the is rejecting from here, this area. You can see now it is cross. Then after that, come back to here, price rejecting. Now it is acting as a support. What is a break and retest? It's like moving average is broke, then coming back is a break and retest. If it is in the downtrend, what is acting like a strong resistance. You can see it was in a falling resistance. Moving average is acting as a resistance all over this area. You can use it a 50, then it will be more accurate because it's a 50 minutes, so 50 is the better. Falling, coming back to here, rejecting, coming back to here, rejecting. Now what happened? It's cross here, starting. Then one price come back to here, there is a chance to bounce back here. So if it is uptrend, how it will be? It's coming for an uptrend. You can see it was an uptrend. Price come back to here, cross above the moving, then it's a rising. That means it's uptrend. come back to here, price coming back here, beautifully reacting from this level. Same before, as I said, it's a rubber band, it will come back to the moving average. See, once moving average is reacting to these price levels, once it is coming back, it will be reacting. If you are not reacting, see, it's break. This example of break and retest. Once break and just we have to wait for the retest. It's coming back to the moving average retest. From there, it came back, and again it's a break, and it took a support and going. Then again, you see, once it is falling to the moving average, what is happening from here? Acting from the moving average, going up, break, retest, and this failure, then break and retest, and going up again, going up again. See how beautifully reacting to the moving average. Price went again, like, okay, closure happened. Then again, this is a flat. We will not take any trade here. This is a sideways movement. See, break, retest happened, going down, break, retest. So it will act as a dynamic support and resistance. By dynamic and support and resistance, we are saying, you can see we already studied about the resistance and support. You can see it is our resistance area last, but here you can see moving average resistance is changing, keep on changing from here. Then you can, it was in a support, it will act as support, but actual support areas here, our normal support area, but it will be dynamic. So once it's coming here, see, it's acting as a support, that is known as a dynamic support and resistance. We'll simply backtest using 200 moving average and 50 moving, or we can put EMA 20 moving average. Okay, so we will just backtest using the replay mode. We can just randomly go here wherever it is. So okay, fine. What is our rules? This long term 200 moving average, if it is price above this one, we will look only for the buy. Okay, then last we studied that if it is stretched here to, there is a chance we are not going to take any reversal here, only we will take the according to the trade. If it is 200 is in below, we will take as a buy trade. So what we will plan here, so we can start from one area here. It's a crossover happen here. Okay, we can put it here. Okay, so here what is happening, we will see. Okay, this is just simple retest only, don't know anything. Personally, I am not using this strategy, but this is the simple strategy, that's why I am introducing to you. Okay, here candle close about the red means here 200 EMA, but we will not take the trade unless this blue one, this EMA 20 has to cross above it. You see this crossover happen here. What is our next program? We have to mark this candle. Okay, and what is our 1:2? We will plan 1:2 only. Maybe we will get 1:3 or whatever it is so fine, but 1:2 is our plan. Okay, this is the first entry area. We'll see what is happening, we're getting or entry or not. Entry trigger, yeah, entry triggered. Stop loss or it, yeah, you see, hit our target 1:2. So what we will have to do, we will put it as a winning trade. Okay, we will winning trade one. Then what is our next? We have to price come back to here, or what we got another area is here. We will plan only buy trade. So we'll try like this also. Once come back to here and price break this one, we will mark this candle and we'll plan for the trade here. Buy. We already got entry, but target will be stop loss here and 1:2. For 1:2, what you have to put, you can put stop level, you put what is the level, risk is here 200, target is 2:9. What is the 2? We can see it. What is the 2? Double of this one. So it takes 276. So have to put the double of this one. We'll see how it is working. We got entry. Yeah, we are, if we are in one trade, don't look at any another trade, just okay, we got that also 1:2. So we can plan this one 1:2. We got this entry also. Once we are in one trade, no need to take another trade. Okay, just I will remove this box. What is another area? We can see here also happen, but that time we are in the trade. Okay, we will not take. Then any candle below the closure, and yeah, this one touch this one, and we can plan one trade from here. See here, this is the candle because it's come back here and close above that one. That's why taking that one. 1:2. 1:2. We have to take 1:2. That also trade, you can see. If it is falling or rising this short term and rising long term, yeah, there is chance for the getting the winning trades. So we are only trading with the trend. Trend is your friend always. Always telling that one, right? Trend is your friend. We'll see next. This one also we got, and as we said that this is rising, but price already away from here, so we will wait to come back the price to this blue line. See, that one is going, taking only 1:2. Okay, sometimes it will higher if you are using that. Okay, what we get is coming to our 200 moving average area, but we will not take trade here unless it's any candle closure above this short term. Okay, we have to strict follow the rules. Yeah, we got this one candle closure, and what we will do, we will plan for the trade here. Don't know what will happen, just this is a rule and we have to follow the rule. Okay, stop loss or take profit, that's up to here. We don't want to worry about it, just take the trade and follow your risk reward ratio. That's it. So we'll see what is happening here. We got entry, didn't hit stop loss, but yeah, it's stop loss. It was in a stop loss trade. Okay, no problem, part of the game. Next we'll go how many trade we took. 1 2 3 4. We will at least minimum 10 trade we'll take. Okay, what happened again? We got the candle closure above this one, but this one is, you see, it's a falling actually. Short term you can see it's a falling, we cannot take it. Will, if you see it's a rising, we can take it. That is why we didn't take the trade, because it's a falling. Yeah, it started rising little. Yeah, okay, then fine. Once this candle closure, we can take the trade here. Delete this one, and this is the candle. Okay, we will take and we'll put the stop loss here. 1:2. 1:2 will take. We'll see how much it is working or not. Yeah, it was a stop loss. It also stop loss trade. Why you can see that one is price is very far from this one. There is a chance price come back to here, and it's already started falling. Okay, so this kind of scenario, what we have to do, we have to wait to back here, price come back here and start rising. We'll see, started falling or rising. It's coming back to here, still no rising, started rising. You see, we have to see like that it's a rising, then we'll see. We will plan one trade here, then 1:2 our target. We'll see what is happening, because it started rising, so it's a good indication. We'll wait, hitting our target or not. Almost near to our target, but not yet. We'll see. Stop loss or target, not yet hit our target, and stop loss also. Yeah, it's stop loss. It's almost came to, you see that one, 2655, but it was one pip movement, it is lost. Okay, no problem, we'll put it as surplus. Still it is in the uptrend, you can see. Yeah, better to entry were when coming back to our long term 200. Then once it's coming back here, then if any cross, better entry will get. We'll have this one, see that one. After this one, we got this one, we can enter here and stop loss here. 1:2 is already hit. Yeah, see, it is hitting. So for better entry, what you have to do, let price to come back to our long term, means here 200. Let price to come back here. Once it's touch here, and consider it as a crossover. Okay, in between this kind of three trades, if we can avoid this, you see, actually no trade, but I just took the trade to show how it will work. Okay, so what you have to do, just wait to come back to price to long term, then any closure above this one, you can take the trade. The next one we will see. That one is okay. Then if you take this trade and just wait to, if you want to add or a 9 average or this one, just wait to any closure below this one, then close that trade. If you are taking this one is 628, it's already gone, didn't close any trade below this one. If you are trailing, you can do like that. This one we got this 1:6, sudden movement happened and we hit here our target, but our target only 1:2. Okay, if it is for the trailing only, then price come back to here, and after closing here we have to plan another trade 1:2. You can see it's running, is hitting stop loss or not. Not yet, not yet, not yet. Yeah, almost came to our stop loss area but didn't hit. Will be, if it is coming back again, yeah, it's stop loss hit. It's a stop loss. Then again, but the scenario is either if you are hitting stop loss only one is going, if you are getting 1:2, that is the risk management. Also here we got another entry, it's almost, yeah, hit also 1:2. Even once getting, you are getting 1:2, only you have to do that one. You have to strict on this rule. Once coming back here price, then closing here, you can take the trade. How many trade now? 1 2 3 4 5 6 7 8 9. We'll take one more trade and we'll see how the risk reward ratio, or it win reward ratio also getting. Now wait, because price is very away from here. So earlier we show that one RSI. In this kind of scenario, we can use the RSI if price away, and if showing any reversal from here, we can take the reversal trade. You can see this one price is coming back here. If price to come back to here and then going above, we can take the trade. From here, if it is far, we can plan one reverse trade to here, but now we are only taking the same direction of the trend. What happened here? It came back here and start tracing. It didn't come here. We'll try one trade here. Here, this one is the closure, and we'll plan one trade here. Same in the live chart also. You can just plan trade and put the stop loss and take profit. That's it. If you are, this is the 10th trade, we will see how many winning trade, how many winning, right, and the risk reward ratio we will calculate now. Okay, just wait to close this trade. We'll see. Didn't net, almost 1 is getting, then it's okay. 1 2 is our, this has to be it. Yeah, 1:2 hit. So we have to one more winning trade here. We'll calculate 1 2 3 4 5 6 winning trade and 4 losing trade. Okay, that means if you are risking $100, so what you will get, 6 winning, 1 winning you will get 200. Okay, 6 into 200 equal to 1200. And what happened, how many loss? 4 loss. What you will have lose if it is, you get 100, because you are 1:2, so 400 you will lose. So 1000 minus 400 equal to $800, you are in the profit. This is the beauty of risk reward ratio. You see, in 10 trade you are winning only 6 times. Okay, winning 6 times only, but winning how much you are getting? 1200. And losing 4 times you already lose. In 10 trades almost 60-40% here. 4 times already you lose, but you are losing only 400. Why? Because you are losing 100 only. Then you got 1200 and losing 400. But finally overall you are in the 800 profit from the this 10 trade. Is good. Example, if you are risking 1000, what will happen? 6 into 2000, 12,000, and 4 into 1000, it will be 4000. 12,000 minus 4000, you are in the profit of 8,000. You can see 8,000 your profit. In 10 trades, this much winning rate is good. And you can see if you strict risk reward ratio, strict your rules, of course any strategy, you can see strategies like, normally telling it's only 20% of the scenario. Balance is how you are getting entry, how you are exiting. No FOMO. No FOMO means fear of missing trade. No, price will come to your entry, no need to jump into the trade. Okay, And also you have to wait to your target. Sometimes earlier also we see that one almost hit to the target but came back to our exit area. See, so what you see here is almost came back to until here 1:6, but it went back to our stop loss. It's okay, fine, but don't worry about it. You have to stick to your rules and do your strategy properly. If you backtest here, this is 100,000. If you are now means 100 times if you are backtesting, almost you will get same scenario here. Okay, that means overall you will be in the profit. This is only example of 10 trade. If you are taking 10 trade, you are risking $1,000, you are winning 6, you are losing 4, then still you are 8,000 profit. It's just a simple example only. Okay, summary and key takeaways. That was a powerful lesson. Here is what we covered. What moving averages are and how they work. SMA one is better. Best moving average for gold trading. How to use moving average as a support and resistance. Combining moving averages with other indicators for stronger trades. If you found this lesson valuable, like, subscribe and turn on notification so you will not miss any of my new lessons. Next, we will explore the super trend indicator, a beginner's guide to spotting strong trends. Traders often say that trend is your friend because they think it's a security that is going up. It's more likely to keep going up, and a security that's going down. It's more likely to keep going down. Having a clear view of the trend can help investors decide whether to buy, sell, or hold a position. However, sometimes determining the trend can be difficult, and that is why the video is so important. A simple moving average is a technical indicator or tool that tracks a security's price of a time period and plots in a line. This essentially smooths out price fluctuations to give an investor general idea where the trend is heading. Using simple moving average to determine trends, as investor can better identify buying and sell signals. To create a simple moving average chart, start by choosing a time frame. A time frame can be any period of time including a day, a week, or even a month. This, for example, will define a period as a day. Let's create a moving average using a 20-day chart. We will take each day's price and add them together, and we will divide that number by our time frame, which is in this case is 20. This gives us today's 20-day average price, which is a short-term moving average time frame and one that active traders may use to create moving average. Each day will drop the last day in the time frame and add 2 days. A 20-day moving average can help determine short-term, uptrend, downtrends, and sideways trends. Terming a security moving average in relation to its current price can help investors identify potential buy signals. For example, when a price break above an upwardly sloping moving average, this could means it's good time to buy a stock. Another buy signal could be a support bounce. This is when the security's moving average act as a support level for the price. When the price comes down in the moving average and then rallies up again, this bounce could be useful as a buy signal. On the flip side, buy moving average can help the investor know when to sell a position. For example, if the stock's price rises moving average and bounces, this might be a sell signal. Looking at a simple moving average over a short-term time frame can be very helpful, but it has a drawbacks. One thing to be aware of wishwave is the one stock crosses over the moving average, giving one signal and then reverse quickly. Giving this opposite signal, a short-term time frame like 20 days usually shows more wishwaves, which is why some investors to use intermediate and long-term time frames. For example, intermediate time chart with a 50-day moving average shows a smoother average and have fewer buy-sell signals. And as a result, investor may stay in the trade longer. Long-term traders look like the self and with a 200 moving average and even a smoother. When looking at all this, the average, we can see that short-term average is confirmed by the intermediate and long-term averages. The main advantage of a simple moving average is that they are slow to reflect price changes. Because each period is given equal weight, day 50 count as much day as 1, but you can see a large gain or drop. Hardly factors into a moving average for some time. This is known as the lag. Let's look at an example of illustrate this. If you use a simple moving average for a buy and sell signal, your stock could experience huge pullback well before the symbol average reflects activity. To avoid lag, consider using another analytics such as a weighted moving average or exponential moving average. These types of moving average consider recent data, the most relevant and give them more weight. Consequently, these types of moving average lines react quickly to the secretive price changes. This is helpful for active who want to place short-term times. It's also important to note that moving average don't predict the future performance, they only confirm established trends. Even these drawbacks, moving averages are powerful tools of technical analysis. They can help in the determining trends and identify buy and sell signals. Thank you. Like, subscribe, and put on notifications. Like, subscribe, turn on notification.